Financial Mappers Pro is the perfect tool for financial advisors and accountants who specialise in self-managed superannuation. You can now demonstrate a full range of strategies to your clients, and if necessary, you can complete your statement of advice in the software. Let's start with setting up a plan for John and Mary, both age 55 and who will retire in 10 years' time. John has a salary of $120,000, however Mary's salary will be just $25,000. This means she will be eligible for both government co-contribution and the spouse contribution should they both make after-tax contributions. Investments outside super will be simple, with just $100,000 in the transaction account and a joint share portfolio with a balance of $100,000. And with dividends paid to the transaction account. 60% of the shares will have imputation credits and the fund will be drawn down over 20 years. This means there will be a zero balance at the end of the plan. The home is debt-free with a current valuation of $1 million. Now we are ready to activate the Self-Managed Superannuation Fund. Note the fund needs to be activated. As the fund is to receive the employer contributions, this option also needs to be activated for both partners. John will make spouse contributions. Now the fund has been activated, let's go back to the investment plan. The investment plan is the quickest way to distribute savings from salary. During each 5-year period, 5% of available savings are allocated to John and Mary's after-tax contributions. Back at the SMSF account, the current account balances for both John and Mary's superannuation are allocated as employer contributions, personal after-tax contributions and personal pre-tax contributions. Of these funds, $600,000 is in the shares and managed fund account and $400,000 in the cash account. In addition, the fund has an investment property valued at $600,000 with a loan of $100,000. When setting up the account, the loan defaults to a 20-year loan. To change the length of the loan, you must click on the link and edit the loan. You can also change the interest rates to include loan costs. To edit the details of the shares and managed fund account, click on the link. Note how the fund defaults to 100% domestic equities in the asset allocation. However, where the user elects to have managed funds, the allocation can be changed accordingly. All the dividends are reinvested and imputation credits can be assigned to the fund. If appropriate, management fees can be included. Likewise, the information for the cash account can be changed if required. While allocating personal contributions for the investment plan is the quickest, some people prefer to allocate a dollar value. If the employer is making more than the regulated superannuation guarantee levy, then these additional contributions can be included here. The program defaults to assigning 30% of contribution to the purchase of shares and managed funds. The intention is to maintain the ratio between cash and shares. The percentage can be changed to meet the required growth defensive asset allocation for different stages of the plan. There is an extensive list of fees and life insurance. For the first 10 years of the plan, the investment profile has been calculated as high growth. That is, the fund has between 20 and 40% of the funds held in cash. The actual percentage for each year is also displayed. Before commencing the drawdown strategy, the first priority should be to plan an exit strategy for real estate. The property is sold in year 17, with 40% of the net proceeds being allocated to shares and managed funds. The program automatically ceases all contributions once the drawdown is activated. To continue making contributions, the number of years for transition to retirement should be entered. Note how the cash account balance for both John and Mary have negative cash balances. It is very important to understand that once either partner's cash balance is negative, either shares and managed funds or real estate must be sold to ensure the balance is positive. Any calculated results where the cash balance is overdrawn will be inaccurate, as the program cannot calculate some information when the balance is negative. To stop the endless rebalancing of the cash account by selling or buying shares, you can nominate a percentage of the drawdown amount to be funded by the sale of shares and managed funds. The net returns are deposited into the cash account at the start of the year prior to the drawdown. The program defaults to a 60% allocation to shares. In this plan, the value of John's account exceeds the indexed transfer balance cap. The program has automatically allocated $2 million to the transfer balance account, with the balance held in the excess accumulation account, which will continue to pay tax on income and capital gains. With the drawdown, there are 3 methods to choose from. In this case, both John and Mary will draw down their funds over 30 years. In addition, Mary plans to draw down an additional $10,000 in year 16 of the plan. The drawdown of this fund is subject to minimum and maximum rules. However, that rule is not applied to the additional drawdown amount. This is not the case in real life, but adds flexibility to the software. The funds held in John's excess accumulation account are not subject to the minimum drawdown rule and can be drawn down as required. In this case, John plans to draw down an additional $50,000 in years 10 and 20 of the retirement phase to fund additional large expenses. Note there are sufficient funds in the cash account to fund the drawdown. If this were not the case, then additional shares and managed funds would need to be sold. The graphs for investment profile, asset allocation, and percentage of growth assets give a very clear picture of the fund over the length of the plan. The fund is currently showing an aggressive investment profile in the midsection of the plan and for the last few years. The percentage of growth assets can be rebalanced by selling shares and managed funds. To increase the fund's defensive assets, 30% of the shares and managed funds are sold in the first year of retirement. Now the investment profile is reduced from high growth to balance for the latter part of the plan. If one wanted to be more conservative, say in the last 5 years of the plan when both partners are over 80 years of age, a further 20% of the fund could be sold in year 16 of the retirement phase. This will see the last 5 years of the plan move to a conservative profile. Select the tab View Data and the investment profile is displayed, and you can monitor your entries as you progress through each 5-year period. Let's look at all the information. First, you have the total fund. You can click on the link to see the values for each partner. In the retirement phase, if either the partner's funds exceeds the transfer balance cap, then the information for the transfer balance account and the excess accumulation account is displayed for each partner. The cash account displays the transactions for both partners, although in reality they are calculated as separate accounts. Note the government co-contribution and spouse contribution in the first 5 years of the plan. Again, the shares and managed funds displays the total for both accounts. You will note that when you nominate the purchase or sale of shares, both accounts are allocated the same percentage. Next, there is the details of the property account. This property is sold in year 17. The program also tracks account balances according to contribution type for both partners. Any funds held in the excess accumulation account are not included in this allocation. At the end of the data view is a list of the personal taxation allocations. Now review the graphs. The fund balances according to contribution type, with the excess accumulation fund separated from the rest of the fund. The fund balances according to the 3 account types: investment profile, asset allocation, percentage of growth assets, combined investment returns, cash account transactions, shares and managed fund transactions, investment property transactions, and present values. If we go to the income plan, you can now enter how much is required each year for personal living expenses. The values have been changed over different time periods, with an additional $50,000 included in year 10 and 20 to fund extra expenses. The income is funded from the superannuation account, share portfolio, and the transaction account. These values are presented in present and future value. Just as you have to monitor the cash account balance in the super fund, so do you need to monitor the transaction account. You should not attempt to draw down more than the funds in the transaction account. You should either move more funds to the account or reduce the drawdown. The retirement income is transferred from the transaction account to the budget for living and other personal expenses. This plan could be developed into the superannuation investment strategy by using the 3 panels on the objectives chevron. In addition, the advisor can now generate a statement of advice from the plan. Simply format each panel to include appropriate information. For example, you may want to start with an executive summary and then move through the other 5 panels. To complete, let's have a very quick look at the superannuation account. On the first tab, you can nominate the values of the fund according to contribution type. The contributions tab is the same. On the next tab, you manage the superannuation investment returns, fees, insurance, change of funds, and rollover to annuity. To convert the fund to an annuity, you must first activate the drawdown in the next tab. You can change the investment profile over different time periods. In this case, the profile has been changed 3 times. Finally, you have the same entries for the drawdown. That concludes the discussion of self-managed superannuation. Now you have all the tools to engage with your clients and demonstrate strategies to help your clients maximise the benefits of their self-managed superannuation fund.